Because let's talk about all of them with Vivek. In fact, HAL is the one which is under pressure after Tejas Light Combat Aircraft crashed during the Dubai Air Show. So we'll talk about that as well. Let's go across to Ria first and then we'll go to Vivek.
Well, yes, Mangalam, as you said, HAL today is taking a hit in the markets, down around 3.5% after on Friday the LCA Mk1A aircraft crashed during the Dubai Air Show. Now, the exact cause of the accident remains unknown, but investigations are underway presently. The engine manufacturer GE Aerospace has also issued a statement after the incident saying that they are offered to prepare their full support to the customer and to the investigation as well. Now, remember, this is the second LCA Mk1A crash in the last 20 months, and the earlier incident had occurred in Rajasthan in March of last year. And on the back of this, Elara has also come out with a note. They have a positive stance on this. They are maintaining their buy rating, and they've said that they expect no material impact as a result of this crash. They've also said that fighter aircraft crashes are not uncommon, and in fact, in the calendar year 25 alone, more than 7 such incidents have occurred across several different fighter jets manufactured by different companies. So this is not an isolated incident. In terms of the expected impact, they have said that they do not expect the news of the crash to impact the total 83 plus 97 unit orders for the LCA Tejas Mk1A and its delivery schedule as well. They also do not expect the aircraft to be grounded, as this incident did not occur during a mission but in fact occurred during an air show. However, they have highlighted that this incident is the second Tejas crashing in the past 2 years, and this may delay exports for the company going ahead. They've also highlighted that they don't expect any major financial impact on the company in terms of the current order book, inflows and execution as well. Nonetheless, the stock is still down around 3.5% in trade today.
All right, Ria, thank you so much for that. That is HAL for you, as of now down 3% in trade. But Mangalam, we are also keeping an eye out on Swiggy and Eternal. Obviously, this is because of the new changes in the labour law, and they do see an impact coming in on this as well.
They do see an impact coming in, but it's a very near-term impact. In fact, if anything, it's a long-term positive, which is why the stock price impact has been fairly limited all through today's trading session. In fact, we've seen recovery for names like Swiggy as well from the lows, even for Eternal, which is slightly under the red line right now, but still is seen a fair amount of recovery. The government has said that gig workers and platform workers are now officially recognized under the Social Security for the first time, and platforms must contribute anywhere between 1 to 2% of their annual turnover, which is capped at 5% for gig worker payouts for Social Security. The benefits will be rolled out via state welfare boards and government schemes. Analysts say for Eternal and Swiggy, which already provide health insurance to riders, which amounts to about 0.7 to 1% of their GMV, if the mandate provides for 2% of sales, the incremental hit could be no more than 150 to 250 rupees in terms of their GMV. This could lead to an increase 1 to 2 rupees, at best 3 rupees per order, which will eventually be passed on to consumers over and above the 9 to 13 rupees that these companies charge as platform fees as well. But from a long-term standpoint, it ensures good upkeep of the riders, and at the same time good supply of riders as well, because now this comes as recognized under the Social Security. So, which is why the companies have said that they welcome the government proposals on gig worker safety. They've been awaiting the final notification before assessing materiality. So let's see how that pans out. But for now, the street has given its verdict. It is near-term disruption, no more than 2 to 3 rupees per order. But from a long-term standpoint, it is positive for the industry.
Okay, all right, Mangalam. Thanks very much for that. So maybe a little bit of near-term disruption. Next up is Infosys and the entire IT sector, which is buzzing on the back of a positive note by Motilal Oswal. Let's go across to Reema on this. Reema.
Thanks so much for that. So Motilal Oswal today has upgraded the Indian tech sector to an overweight, and there are 3 key reasons for that. One is the underperformance. This year, the Nifty IT index is down 12%, underperforming the broader market. But even over the last 3 years, the Nifty IT CAGR is meager 8%, much lower than the 13-16% CAGR return that the Nifty 50 or the Nifty 500 clocked in. Number 2. Global AI hyperscalers are experiencing diminishing marginal utility from infrastructure build-out, which typically signals that the shift, now the attention will move from spending their money on building infrastructure to actual services, application and maintenance, which is where the Indian IT companies come in. And thirdly, on valuations, Motilal Oswal says the profit pool of the IT stocks has remained constant for the last 4 years at 15%. but the weightage of IT stocks has been dropping, and now it's at a decadal low at 10%. So therefore, valuations are attractive, which is why they've raised the rating on Indian IT from an underweight to now a marginal overweight. And their preferred pick is Infosys. They believe this company, Infosys, will be the key beneficiary of the enterprise-wide AI spend, and current valuations of 21.7% make the risk-reward favorable.
All right, Rima, thanks a lot for that. Now, as